Hello there, everyone. Happy Tuesday, November 19th. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, founder of Market Misbehavior, coming to you not from a very windy Redmond, Washington, or in the Redmond area. Already looks like wind is coming very soon. They're sort of saying around 2 p.m. local time. Actually coming to you from New York City here for the week. Doing some events with the CMT Association and hopefully safely heading back to Seattle first thing on Friday morning. Hope you guys are all doing well and staying safe wherever you are at. As we look at the markets today, big news, I think looking forward to this week is earnings on Wednesday from NVDA, and that is tomorrow. So we're going to look at the chart of NVIDIA having a pretty decent update, actually one of the top gainers in the S&P 500, up almost 5% at the close. We'll also look at some of the big box retailers like Walmart and Lowe's, which reported earlier today. This is sort of a lighter news week, I guess, assuming there's no sudden, one-off news events. But the story is going to be earnings, I would say, with some of these names that are reporting, particularly with NVIDIA. Nice risk on day for the Nasdaq. Not a lot of follow through in things like the Dow. With that in mind, let's get to the market recap and see how things sort of played out. Looking at our market overview, you can see the S&P 500 finishing the day just below 5920. That's up about 0.4%. from yesterday's close on Monday. The Nasdaq Composite finishing just below 19,000. That's up about 1%. The Dow, as I mentioned, lagging. So we sort of had, Nasdaq over Dow as a general trend to the week so far. Mid caps essentially flat for the day, and small caps actually having a decent day, not performing quite as well as the S&P large cap, but still doing okay. And the VIX actually pushing higher. And a friendly reminder, if you assume that the VIX is down because the indexes are up, not always the case. And while that's a general inverse relationship, stocks can move higher on higher volatility. And that's basically what we observed today, with the VIX finishing the day just below 16.3. Looking at the fixed income areas in the market, we can see the 10-year and long bond points, also the 5-year point on the yield curve moving slightly lower. The 10-year yield is around 4.38. The long bond yield just below 4.6%. The TLT, which is a bond ETF that we like to track, up about 0.5%. The dollar actually just finishing essentially right where it was on Monday's close. And that's kind of a refreshing change, because the general uptrend in the dollar has been sort of the story here in the month of November so far. And that's caused a lot of pressure on this group of things, the commodities, and particularly the precious metals. With the dollar flat, that means gold, silver, other commodities able to move slightly higher. Energy was the top performing sector on Monday, actually down toward the bottom of the list today, even though crude oil prices were up slightly using the USO. And the GLD, which we do own in our accounts, up about 0.9% today. Looking at the crypto space, sort of Bitcoin up and most other things lower. Bitcoin did briefly touch 94,000 for the first time in history earlier today, and currently down a bit off of that, just below 93,000. We're getting closer and closer, I feel like, week over week, to that 100,000 level, which seemed like an unreachable pinnacle at some point. All of a sudden, very reachable, not too far above current levels, to be honest with you. Most of the other top 10 coins tracked on the stock charts platform were in the red. Looking at the 11 S&P sectors, you can see kind of mixed results. The technology sector back at the top of the list. Tech, particularly the XLK, was up 0.8%. Communication services and utilities both up about 0.2% today. 5 of the S&P sectors were down, led by financials, down 0.7%. That's interesting because financials have actually been one of the better sectors, particularly on a relative basis, over the last 6 to 8 weeks. Energy and healthcare both down just over 0.5% today. Looking at the Magnificent Seven and Friends, sort of these mega cap growth names, we can see NVIDIA, which is out with earnings tomorrow. As I was talking to my premium members over the weekend, sort of setting the stage for the week to come, keyed in on NVIDIA's earnings on Wednesday. Certainly has market moving potential. Now the largest stock by market cap in the world. So certainly a lot of eyeballs will be on that report. That's up about 5% today. So certainly seeing continued optimism going into tomorrow's report. Netflix, number 2, up just under 3%, and Tesla continuing to follow through after that post-election bump, up just over 2%. Apple's the worst performer, still slightly above the zero line, and Microsoft up about 0.5%. So the other sort of mega cap tech names not really dominating the returns just today. All right, let's look at the market carpet. And I want to thank all of you that attended our webcast earlier today, talking about the 3 steps to every price pattern. We look forward to doing another free webcast, hopefully in mid-December. And I hope if you missed this one, you'll be able to join us there. But we talked about a couple names, which I'll get to here, looking at the market carpet. Just a general way we approach this visualization, 3 pieces. Number one, sort of your general impressions. Sort of a mixed day, I would say. Quite a bit of green, quite a bit of red, quite a bit in neutral. So sort of a modeled appearance, and that makes sense if you look at what the benchmarks did with the Nasdaq up, the Dow down, the S&P in the middle. This is kind of what I would assume the market carpet would look like, sort of a mixed model day appearance. You can see some things like NVDA, obviously up quite nicely, and other things really across a number of the sectors deeply to the downside. Step 2, we look at the biggest names and the what I call the big dogs, the ones that have such a significant weight on our major benchmarks. Besides NVIDIA, as I mentioned, the rest of mega cap technology not really doing particularly well, and both Microsoft and Apple actually underperformed the S&P 500 today. Alphabet, Meta, Amazon, Tesla all having decent up days. Netflix as well, up about 3%. So overall, the Magnificent Seven actually doing okay today, and certainly in no small part of the positive story for the Nasdaq Composite. Finally, let's look at some of the sort of particular themes, individual names on the move, things that are fluctuating that we want to make sure we highlight, sort of the outliers. Things that come to mind, particularly in the financial sector, obviously one of the less strong days that we've seen recently. We've talked a lot about the financial sector and some of the opportunities there, given the interest rate environment, giving a Trump administration, which most likely involves sort of lighter regulatory pressure on banks. But overall today, sort of giving back some of those previous gains. FIS stands out as the worst performer within the S&P financial sector, down about 2.7%. That's an interesting one because it hit around $92 a share in mid-October. Now down quite a bit from there, around 6-7 points from that peak, down another 3% today, and now putting in a bit of a lower high in the month of November. And that's the first sort of lower high that we've seen since probably back in July, to be honest with you. Other thing I would note is within the technology sector, again, we have names like Texas Instruments, which is pulling back towards $200 a share into it, which is down over 5% today. This is SolarEdge and First Solar, some of the renewable energy names, which honestly have been sort of on the struggle bus since the elections, given a Republican and not a Democrat in the White House here. Other bullet points I would highlight within the consumer discretionary sector, talk about a fairly diverse sector in terms of their businesses, in terms of the industry groups, but especially in terms of the move today. You have Lowe's selling off about 5%. They report earnings today. Borg Warner, Ulta, Advanced Auto Parts, Bath and Body Works, all having pretty strong down days. Couple things actually moving to the upside. And when you have sort of a bigger a lot of stocks going down, I always like to see what is doing the opposite. What are the things that are actually up a bit? Caesars and some of the gambling stocks have had a bit of a bounce this week, but it's still within, I would argue, a primary downtrend. I don't know if that's necessarily, the best opportunity I've seen. Carnival and other cruise lines, some of the airlines, if you look at the industrial sector, actually continuing to do quite well. Here's Carnival up 2.5%. Airlines are up here in the industrial sector. You can see UAL that's actually getting very close to $100 a share, which again has been a nice consistent uptrend to get there. Delta Airlines also making a new 52-week high here in November and continuing to have a decent up day as well. As a reminder, I can see the questions that are coming in on any of the live stream platforms that we're sending this out to. We are currently sending it to Facebook, LinkedIn, YouTube, and X. I appreciate so much wherever you're digesting this live stream, if you're watching this live, and wherever stream you're on, you can just put a comment wherever you're able to do so on that platform. I can see them all here, and at the end of the show, I'll try to take a question or two before we wrap up. All right, let's go to the chart review and focus on some of the individual names on the move. The S&P 500 will start sort of macro to micro. So the S&P 500 over the last couple of days, kind of, chopping around, I would say, after Friday's gap lower to around 58.50. That was Friday's session there. Then we have Monday and now Tuesday. We're sort of back up toward the high of that gap down day on Thursday of last week. We're just above 5,900 at the close here. So for now, it appears the S&P stabilizing after that gap down on Thursday. For me, I generally think of chart analysis for my purposes as number one, defining the trend and following that trend, and then just determining what would tell me the trend has changed. So I would argue, taking a step back, anything above kind of 56.50, I would generally describe as noise, barring some very clear price patterns, some very clear candle patterns that would suggest severe distribution, some sort of divergence with momentum or volume, something that would tell me there's a big distribution happening. That sort of thing aside, I think this is sort of choppy, noise above here, because overall, we're in a pattern of higher highs and higher lows. The primary trend is higher, which means as long as we hold 56.50 to 5,700 on any pullback, we're still okay. And a move down to that level would be about a 6% drop off of the all-time high from about a week and a half ago, just above 6,000 for the S&P 500. So overall, primary trend is positive. The momentum overall is strong, but not excessive, with the RSI pretty consistently above 50 and above 40 on major pullbacks. So overall, I would describe the technical structure of the broader market as fairly constructive here. Now, it's not all great, and as always, when I see a market in an uptrend, I'm always looking for signs of disagreement. Right? What tells me that maybe things are not as ideal as I would anticipate, looking at the S&P making a clear pattern of higher highs and higher lows. This is one of my favorite breadth indicators: percent of stocks above their 200-day moving average, and the bottom panel, percent of stocks above their 50-day moving average. Let's start with this one. The percent of stocks above their 200-day moving average has been essentially between 70 and 80 for the last 3 months. And really going back to the beginning of this year, we've essentially been right around 75% of the S&P members above their 200-day moving average. That's not kind of a long-term breadth indicator. As long as that remains above 50%, I'd say the long-term structure of the market is still quite positive. Right? When something like the S&P finally breaks below its 200-day moving average after being above it for so long, that would tell me something's different. For now, the long-term breadth, as you can see, pretty good. Look at the bottom panel, though. You can see on the short term that the breadth conditions are not as attractive. As of today's close, we got down to around 54% of the S&P members above their 50-day moving average, which means it's about a coin flip if you pick a random stock in the S&P, whether it's above or below the 50-day. And that is not, generally speaking, kind of a bullish configuration. What you want is over half of the S&P above their 50-day, which implies that more stocks than are in an uptrend than are in a downtrend. That comes after a bearish divergence from early October to mid-October, where the price or the value of the S&P sloped higher and the breadth indicator here at the bottom sloping lower. So generally speaking, we're seeing deterioration in the short-term breadth. The McClellan oscillator, which I'm not showing here, remains below zero. So the short-term, kind of the tactical breadth, I would argue not as constructive, but the long-term breadth still fine. So that sort of plays into the short-term pullback kind of chop within a primary uptrend until proven otherwise. That's about what this feels like looking at the broader market. Also, in the interest of looking for warning signs, looking for signs of conditions deteriorating, just wanted to update you quickly on the Hindenburg omen. This is an indicator we don't bring up too often because it doesn't signal very often. It actually only signals once every year or two on average. And it really is designed to identify the conditions consistent with major market tops. It combines a series of different indicators. Number one, you want the trend in the market to be positive. And in that way, we look at the rate of change over the last 50 days for the New York Composite Index. And the trend clearly has been positive. You don't even need to see that indicator to know that the trend in the markets has been positive. You need an expansion in new highs and new lows. And that's actually a crucial part of this indicator. What the creator of this indicator determined by analyzing a bunch of market tops was at a major top, you had an expansion in new highs and new lows. Kind of there was confusion and stocks doing different things. And that often was one of the great signals that he identified, kind of counterintuitive. And so we need new highs and new lows to be at least 2.5% of the listings on the NYSE. We've not quite gotten that. Today we were very close, but did not quite get there. It would have to be negative 0.025 and positive 0.025 to trigger that second alert. And then finally, the McClellan oscillator needs to be below zero, which suggests short-term negative breadth. As you can see from the indicator here, which is a composite indicator that tracks all of those conditions on the stock charts platform as of yesterday's close, that is only flashing for 2 of those 3 items. And so for now, no signal yet on the Hindenburg Omen. For this signal to be confirmed, you need multiple Hindenburg Omen signals within 1 month, within 20 trading days. We've had a couple initial signals in 2024, most recently at the beginning of September, but we've not had that second signal within about a month. So as a result, I consider the McClellan oscillator still not firing. The last 2 times we had the McClellan oscillator signal was at the end of 2021 and at the beginning of 2020, basically the 2 most recent major tops in the S&P. So we'll continue to monitor that. I just wanted you to note and recognize we are very close to another potential first signal. We would need to see a confirmation within a month. We'll certainly track those indicators here on the show. In our webcast earlier today, where we talked about different patterns, actually, that's not true. This was earlier this morning. I did a show for Stock Charts TV. That's where I showed this chart, or a version of this chart. On the Stock Charts TV YouTube channel, I did a video talking about sector rotation. We talked about the RRG, and we talked about looking at sector relative strength. And I just want to highlight the 4 sectors having the strongest relative improvements so far over the last 3 or 4 weeks, so kind of late October to now mid-November. From the top are consumer discretionary, communication services, financials, and energy. And the reason why I say they're the strongest, because these are the relative performance lines, the relative strength lines, looking at the sector ETF versus the S&P. And these lines sloping higher means these sectors are outperforming the S&P at least over the last 4 to 6 weeks. So those are your 4 areas of strength in a market that is sort of chopping around and questionable. Consumer discretionary really driven by Tesla, Amazon, and others holding up. Communication services driven by some of those larger names like Alphabet, trying to continue their trend higher. Meta's in that group as well. Financials with all the banks, regional banks, capital market stocks, and then energy with crude oil prices maybe starting to bounce off of support, starting to get a bit of a bid here in the month of November. Generally speaking, if you want to outperform the S&P 500, you need to own things that are outperforming the S&P 500. I want to direct your attention to those 4 sectors that are actually getting it done here in the month of November. One area of the market not getting it done is the semiconductor group. This is the semiconductor ETF, the SMH. We can see that really from a technical perspective, the SMH has stalled out with 255 to 260 serving as resistance a number of times here over the last 4 months. Most recently, we hit 260 in early November. We've now pulled back to test the 200-day moving average. I would say in terms of pure price analysis, one of those things is going to break here at some point. This is almost a bit of a triangle pattern or a coil pattern. And at some point, we either break above 260 or below the 200-day moving average. I would say that move, whichever way we break, is probably the next major direction of momentum. That's what I would assume I would follow. However, the bottom panel shows the relative performance of semiconductors, the SMH, versus software, the IGV. If that ticker sounds familiar, in my most recent podcast interview with John Kosar, we talked about the IGV, talked about the software space versus other groups within the technology sector. So make sure you review that conversation if you want to know more about that ETF and what was so compelling compared to other areas of the technology sector. Here we can see semiconductors underperforming software. That has been a theme that has been in place for really about 4 months, and that's going into the biggest semiconductor, NVIDIA, reporting earnings tomorrow, in case I hadn't mentioned that enough so far on today's show. A couple more charts, and then I'm happy to take a couple questions, and we will wrap this Tuesday episode of Chart This. In terms of other companies reporting earnings, Lowe's, obviously a big box retailer, home improvement store, along with Home Depot, breaking down today, gapping lower. This is earnings day for Lowe's and also Walmart, which I think we'll show next. What concerns me about the chart of Lowe's is this gap lower really completes a couple things. Number one, that puts us back below the 50-day moving average, which is often where a pullback ends in a constructive framework. Here, we're actually breaking down through the 50-day, which is not as ideal. That also means that that peak from about a week ago now makes a lower high for the chart of lows. And if you look at the bottom here, we can see the relative strength stalled out around 60 on that bounce higher. So in a bullish phase, usually the whole range of the RSI moves up, and we get up to the overbought condition on a rally, and we remain above 40 on pullbacks. You can see that here in like December of 23, January 24, February. You can see where the whole range is up. You can see that most recently here in like July, August, with the pullback to a 50-day and the RSI stalling out just above 40. We become overbought again as we break out. Now all of a sudden we're pulling back, and the concern is, does 40 hold? Now that we've gapped lower through the remainder of this week, I'm keen to see if the 40 level for RSI is going to hold, and if not, that really implies we're in more of a primary downtrend now for the chart of lows, which is a bit of a change of character from what we've observed going into the fourth quarter. Walmart having a decent up day post earnings before the open today. They're up about 3% today. It's a new all-time high for Lowe's, pushing just toward $88 a share today. Closed about 3% higher, so it did come off a bit from the intraday high, but that's another gap higher to a new high. Charts like this above two upward sloping moving averages with the relative strength making new highs. We should be so lucky to have charts like that in our portfolio. The opposite of the good news of a Walmart is Jacob Solutions. This is another earnings name today. It's a heavy construction name in the industrial sector. Actually had a pretty big down day earlier. That was Thursday of last week. We had that big down move. Closed above or closed right at $150 a share. This was Wednesday of last week. Thursday, we had a pretty decent sell-off. Friday, Monday, and now Tuesday, closing below the 50-day moving average for the first time since September. What concerns me about the chart of Jacobs is not the sell-off, although that doesn't make me feel great. It's this bearish divergence that was going into this week, right? So a lot of times going into earnings, you looked at the momentum picture. Here we've had a lightening of momentum as we've been making new highs, and that often indicates the end of a move. And now you can tell that this gap higher turns out to be sort of an exhaustion gap, that last gasp higher before we lose momentum and rotate lower. We kind of saw a bit of a similar thing here in February and March, where the stock was making new highs on weaker momentum. We saw that here in August, September, October of 23, leading into a major top. So this has happened before just on this chart. And the fact that that was the setup going into this week, not a great feel for Jacob Solution, ticker J. Two more charts to leave you with, and then I'll take a couple questions to finish the show. NVIDIA, as I mentioned, yet again, reporting earnings tomorrow. Can't stress how important that is. You know, for me, line in the sand is 130. A break below 130 after earnings tomorrow would mean a break below the 50-day and a break below the most recent low in October. Now, you saw that bearish momentum divergence in Jacobs going into this week's earnings. You see a similar bearish divergence for NVIDIA, which is a bit of a concern. Having said that, stock actually rallied almost 5% today in anticipation of tomorrow's earnings. So overall, I consider this trend bullish until proven otherwise. We close below 130. That would prove it otherwise, at least in the short term by my read. Finally, let's finish with a chart showing just classic constructive behavior. HUBB, which is a technology stock. You can see the resistance in April. You can see we broke above that resistance in September. We pulled back to the breakout level around 420 in late October, which was also the 50-day moving average. We broke to a new high. We pulled back to an ascending 50-day moving average. Overall, that's sort of a long and strong, consistent uptrend with pullbacks that remain right at an ascending 50-day moving average. A constructive chart until proven otherwise. I would say today sort of continuing that uptrend vibe we've seen on HUBB for quite some time. All right, let's take a couple of questions here from the gallery. Smokey watching us on YouTube. I remember Sherman McClellan having a longer-term oscillator. Do you use it as a reference? I actually had a chance. I think I mentioned this on the show, and if not, shout out to Tom McClellan. He's out also in the Seattle area. I had a chance to meet up with him a couple weeks ago, which was really good. I hadn't seen Tom in years, actually, and it was really good to chat with him. We talked a lot about his parents, Sherman and Marion McClellan. We talked about Sherman really getting started in Los Angeles and being on local public access TV with the financial coverage. And back in the day, that's sort of the pre-CNBC, pre-FNN, or these local stations around. And he would go on the local station in LA and share his indicator, which he created, which ended up being called the McClellan Oscillator. And that was the host of the show. I was told that sort of gave it that moniker, named it after Sherman McClellan. talking with Tom, yes, there's an indicator called the McClellan Summation Index. I actually use the McClellan oscillator primarily, but on the stock charts platform, they do have the McClellan Summation Index. I think that's in, yeah, here we go. I was going to say, I think it's in my breadth chart list. So the McClellan Summation Index essentially turns the McClellan oscillator into a bit of a trending indicator, kind of making an advanced decline line based on the McClellan oscillator is how I would generally describe it. Overall, if that's above zero, the trend is positive. It's below zero, the trend is negative. And it's really more of a longer term breadth indicator. As you can see, it's come down quite a bit from October to November, still remaining above that zero line. So overall, still okay. But that's certainly something to watch as well. I feel like I have enough breadth indicators on sort of that long-term time frame, which is why I don't refer to this too often. But if you're interested, you can definitely read that. And by the way, systems like stock charts have really good help pages, what's called Chart School. It's a free part of the Stock Charts website. If you go there and search for the keyword McClellan Summation Index, you'll get the formula and details on how to use it. And I hope you find that to be helpful. All right. Another question off of YouTube. Dave, what are your thoughts on using moving averages on long-term charts for exits and entries? I don't have a problem with that at all, right? So I tend to think of technical analysis as a series of checklists, right? So when I look at a chart, I actually have 7 steps that I check off, and I used to do it by hand as I was learning the technical toolkit. Nowadays, I kind of do it mentally, but one of the 7 items is moving averages and things that I would look at on any chart versus their moving averages. Where are they at relative to the 50 and 200-day moving averages? Are the moving averages sloping higher? As we saw with the example of HUBB, that last chart that we looked at, pullbacks to an ascending 50-day moving average within an uptrend have often been a really good opportunity to buy in on the dips and buy in on short-term weakness, sort of buy the pullbacks within an uptrend. William O'Neill, creator of Investors Business Daily, really promoted that approach. He usually called it the 10-week moving average instead of the 50-day, but kind of the same thing. And so overall, I would say absolutely. I would also say on a longer term time frame, things that go below their 200-day moving average, I generally avoid. Because my style of investing, I'm looking for growth. I'm looking for strong charts getting stronger. So by avoiding things below their 200-day moving average, I'm just avoiding the things that are not in an uptrend at the moment. And I'm focusing on things that are. So absolutely using moving averages like that make a ton of sense to me. If I was designing a trading system, this is not your question, but if I was designing a trading system based on technical indicators, I would use exponential moving averages. That's why my market trend model is based on weekly exponential moving averages. Exponential averages are more sensitive to the most recent observations. So as a result, that's really could be a much better foundation than simple moving averages for some sort of trading system. Something to think about if you're looking for some sort of timing tool. MACD and other indicators are all based on exponential averages for that exact reason. All right, one more question from X. Any idea why the bullish percent index has gone from 81-ish on the end of September to 62 today? Yet I don't know what, I think that just means S&P 500 up 3.1% since then. Nasdaq up 4.8%, Russell up 4%. Right. So how is the bullish percent index down when the indexes are up? That is a brilliant question. I appreciate that so much. And I'll tell you why. Here, let's look at on the Mindful Investor Live chart list. I do have the bullish percent index on the S&P 500. We'll look there. So this is the bullish percent index in the top. And basically, this is what you're referring to. How can this happen on the bullish percent index when this happens on the major indexes? Fantastic question. Here's what it is. Couple things. I would say number one, what this tells you are certain stocks are actually not doing as well as the benchmarks, right? So if you look at the S&P 500 from late September through mid-November, we're in a clear uptrend, but the bullish percent index has been trending lower. And what that means is a lot of individual names, most likely not the big weights like the Magnificent Seven, are actually already breaking down. The reason why I think that's concerning is because the bullish percent index is based on point and figure charts. And if point and figure charts start to, they really need to break down. The price needs to break down quite a bit for a point and figure chart to actually register a sell signal. So that means from 82% down to 62%, that's a full fifth, that's 20%. are about 100 of the 500 S&P 500 names that have registered a sell signal on their point and figure chart in the last 6 weeks. And this is as the S&P is making a new all-time high, pushing above 6,000. This is why we look for breadth divergences, because while the S&P is trending higher, breadth indicators are actually trending lower. And this is one of those examples. So the math works out, because if smaller names within the S&P can do whatever they want, and it won't register on the chart of the S&P because those are geared toward the mega cap stock. So it most likely means smaller names that you don't think about as much are actually starting to break down quite a bit. And that suggests some instability. That suggests that there's selling that's happening, even though the broad indexes really aren't doing so. What's interesting, the equal weighted S&P is actually trending higher during that period as well, and so it is a bit counterintuitive. But because that's an equal weighted measure of market breadth, what it tells you is that there are stocks out there that are not going up. As a matter of fact, there are actually stocks that are going down quite a bit, and it's more and more stocks that are doing so. It doesn't guarantee that we're going to have some downtrend. I mean, that actually happened. That same phenomenon happened here in January and February, where the same indicator came down quite a bit and the market went higher. And do you remember why that was? That was really the golden age of the Magnificent Seven here in early 2024. That's when we really talked about the Mag 7 names, the rebirth of the Mag 7, as they really led the way to the upside. So it suggests that things are not as good as the major benchmarks would indicate. And that's why looking at market breadth is so valuable, because it's the kind of thing that would not be readily obvious by looking at the major averages on their own. Folks, I want to thank you guys so much for joining me here on the live stream or the recording, wherever you're at. I appreciate all your thoughtful questions. As always, you guys are active. You're asking questions, answering each other's questions, and I appreciate it so much. It's a pleasure to facilitate that in some way. Wish you guys a great rest of your week. We'll be back with a live show tomorrow. And until then, I'm Dave Keller with Market Misbehavior. Remember, it's always a good time to own good charts. Have a good night.